Silence. Silence is often confused with safety, but silence is not safety. And in the markets, silence is just the sound of the guillotine blade being hoisted up before it swiftly and excruciatingly drops. Right now, I'm pretty sure your portfolio to you feels invincible. Volatility is crushed, the VIX is asleep, everyone is selling puts and collecting premium like it's free money found on the sidewalk, right? But here is the paradox that retail traders never understand until our accounts are liquidated and bled dry. The safer the market actually feels, the more dangerous it actually is. Because stability inherently breeds instability. There is a mechanical trigger hidden in the plumbing of the financial system. It's not the Fed, and it's not earnings. It's not the ECB, it's not the BOJ, and it's not the price earnings multiple. It's a mathematical breaking point where the insurance everyone sold you suddenly turns absolutely toxic. It's the volatility feedback loop. So today, boys and girls, to the 5 of you watching, I'm going to show you exactly how this trigger works. I'm going to show you why the smart money is currently hedging for a disaster while telling you to buy the dip, and why that optionality seems so cheap, which implies that there is no disaster around the corner. If you want to avoid being a liquidity that allows people to exit, you need to watch this. We are going to dissect the short volatility trade that is currently holding up the S&P 500. We'll look at dealer gamma positioning like we have before, the invisible hand forcing markets higher, and finally, I'll show you the exact level on the S&P where the dealers switch teams and start selling with gusto into the crash. So if that sounds interesting to you, give me a like, give me a share, give me a subscribe, or don't. My name's Justin Banton. This is the House of Trade. So let's talk about charts. Let's get into some charts. But first, as a warning, if you think stocks only go up, go watch some cartoons, because this is for the adults in the room. Let me introduce you to The Concept by Nassim Taleb, but I'll dumb it down for those of you who are Robin Hood traders. I know I'm joking. Imagine a turkey. Every single day, the farmer comes out and feeds the turkey. He's a nice guy. The turkey thinks he's getting a good deal, right? And why wouldn't he? It's consistent, it's predictable, and history is apparently rhyming and repeating. So what happens on day one? Day one, we have the food. We have safety. Day 100, food, safety. Day 999, food, safety. So from the turkey's perspective, using turkey statistical analysis and historical data, the farmer is the most benevolent, safety ensuring entity in the entire universe. The turkey's confidence is in its safety, and it is absolutely assured at its peak on day 1000. Unfortunately, what happens on day 1000? Day 1000 is the Wednesday before Thanksgiving. Now, given all the models, the turkey would be fully compensated and fully understood and forgiven for thinking that everything's fine, right? But right now, the market is that turkey. We have been conditioned to believe that every dip is a buying opportunity, right? The last year, the farmer, Jay Powell, has fed us with liquidity ad nauseum. We are absolutely overweight on it. And this creates a behavior called volatility suppression. Look, big hedge funds aren't just buying stocks. They are actively selling volatility and making a lot of money. They are writing put options to harvest the yield because bonds pay peanuts and they need to justify their 2 and 20 fee structure to their investors in the Hamptons, right? Here is the joke, or maybe not a joke, maybe like a gallows humor, right? When everyone sells insurance, nobody is prepared for the fire. And the arsonist, he's already inside the building, toying with the gasoline and spilling over the accelerant. So let's get technical. If you click off now, enjoy your losses. Up to you. I would stick around if I was you. And I would also like, share, and subscribe if I was you. But just a piece of advice from me. Now, when you buy a call option because you saw a ticker on Reddit, who sold it to you? That's the question you need to ask. Who sold it to you? A market maker, obviously. A dealer. That person who is nondescript and anonymous behind the screen. These guys never ever gamble. Their business is to hedge. If they sell you a call, they are short the call. So to hedge it, what do they have to do? We've spoken about this before. They have to buy the underlying stock. This is called delta hedging. So let's rehash that. If they sell you a call, they are short the call. They have to therefore buy the underlying stock to hedge their own position. But here is where the accelerant comes in. When the market is calm and grinding up, dealers are usually long the gamma. Now this means one thing. If the market drops a little bit, they have to do what? They have to buy the dip to re-hedge. If the market goes up, they have to sell into the strength. So they're acting a bit like shock absorbers. They're dampening volatility. And this is what I mean about volatility suppression. They make the market feel safe. They are the reason the VIX is constantly trading at 11 to 13 range, and your complacency and my complacency is trading at all-time highs. But, there is a price level where all of this actually starts to flip. This is the gamma flip. It is the volatility trigger. It's the thing we want to be aware of and to avoid at all costs, because below this level, dealers become short gamma. Suddenly, all of the math changes. It changes with rapidity and aggressive rapidity. If the market drops, they don't buy that dip anymore. They have to sell the futures to hedge their books. Their selling drives the price down even further, which does what? It forces them to sell even more. That self-reinforcing feedback loop, that cascade of conflagration and hemorrhagic losses, right? It's the feedback loop from absolute hell. A self-reinforcing crash mechanism. And right now, we are dangerously close to that flip line. Look at the put call spread. Look at the skew. Look at the implied volatilities. Look at the cheapness or the richness of the optionality. Just pause my video and comment below. Do you even know what your portfolio's delta exposure is? Like, honestly, real question. Or are you just hoping that line goes up? Be honest with me, be honest with yourself. Don't be honest with me, be honest with yourself. So let's go back to our narrative, right? Make it a narrative and make it a story. Let's introduce Chad. I don't know why Chad. Chad sounds like a guy who works on Wall Street. Chad is running a short volatility fund. Chad is a genius in a bull market. He sells those puts, he collects that premium, and he leases a Porsche or a Ferrari, who knows, right? Chad looks at the VIX every single day. It's the fear index, as he's mediocrely and rudimentarily dubbed it to his clients to make them understand. And he says, hey, look, it's low, no fear. Time to leverage up, guys. But the VIX isn't a gauge of future risk. It's a gauge of the current price of options. And that's where most people get confused, because to be honest, CNBC is touting the VIX as a fear gauge. A low VIX just means insurance is cheap. It's the current price of the options, right? When option insurance is cheap, people like Chad sell way too much of it, right? Remember 2018? You might remember the Volmageddon, as it was dubbed. The VIX went from 1.9 billion to zero in an afternoon, right? And that was a big VIX fund as well. Why? Because the trade became overcrowded and oversubscribed. There was no more space for the passengers. When the market finally snaps, who knows what the trigger's going to be, right? It could be a hot CPI print. Maybe it's a war headline. Maybe Jay Powell sneezes during a press conference, and instead of saying good morning, he says good afternoon. And what happens? The VIX misinterprets it, and it absolutely spikes. And when the VIX spikes, Chad gets a margin call. To meet the margin call, Chad has to buy back the options he sold. Buying back the options drives implied volatility even higher, which triggers margin calls for Chad's friends. Brads, Fads, Pads, Sads, I don't know what their names are, right? Something that ends in AD. It's a liquidity air pocket. The bids all vanish and the order book becomes a ghost town. And that is when you see the S&P or the Nikkei drop 3% in an hour while CNBC and Bloomberg anchors stare at the camera like deer in headlights. I'm trying to explain it away, like why did it happen? Oh, what the technical analysis is, but without telling you what the actual mechanical plumbing of the market is. It's the financial equivalent of a crowded theatre where everyone is glued to their phones and someone yells fire, but their exit door is the size of a cat flap. Good luck fitting your portfolio through that, especially when there's 1,000 other people trying to get through that cat flap at the same time. Now, we have to move on to the buy and hold boomers. And they're screaming at their screens right now. Earnings are good, don't worry, man. The economy is strong. What are you talking about? Does it matter? Does it matter at all, they're asking? And I mean, they've been the winners, right, de jour, and for the past 5 decades. But here's a lesson in market structure. Liquidity is a coward, and it disappears when you need it most. It's never around when you need it, the spreads widen when there's danger, and you can't get filled without horrendous slippage when you need it. Let's take it back to 2020, during the COVID crash. Do you remember? That's a period of time I want to forget, right? Even the treasury market in 2020, the bedrock of the global financial system, froze up. Why? Why did it freeze up? Because everyone was on the same side of that volatility suppression, short gamma, long calls boat, if that's such a thing, right? Currently, we are seeing record concentration in a few tech names. You know the culprits. You know them. Nvidia, Microsoft, Apple. Those stocks are collateral for the entire market. Wait, do you guys say Nvidia or Nvidia? Nvidia or Nvidia? I don't know. I prefer Nvidia. Anyway, if the volatility trigger starts to hit, these aren't safe havens anymore, right? They are the source of funds. Anything that's not bolted down gets absolutely sold. It doesn't matter. Traders have a saying, in a crisis, correlations all go to 1. And that's the fancy speak for saying when the volatility trigger snaps, they don't sell what they want to sell. They sell what they can sell and what they have to sell. Gold gets hit, silver gets demolished, Bitcoin gets absolutely pummeled into the ground because Chad, Thad, Rad, Brat, whatever their names are, they need cash and they need it now. So if everything crashes together, if all correlations go to 1, where do you hide? Is there any shelter from the volatility storm, or are you just destined to be the collateral damage? I'm not just here to spread doom and gloom and ask you to subscribe. Maybe the latter I am. Though I do enjoy it sometimes, I guess. I'm here to give you the radar. Here is what to watch when volatility expands and the SH really does hit the fan. I didn't mean to rhyme that. It's just a natural proclivity, an embedded skill I must have. First, the VIX term structure. Normally, long-dated VIX futures are higher than near-term. Makes sense, right? That's called contango. We've spoken about it before. It's healthy. If the near-term VIX crosses above the 3-month VIX, known as backwardation, you might want to run for the hill. That is an alarm bell. That is the canary in the coal mine. That is the smoke coming out of your engine that you want to ignore, but you shouldn't, right? Second, credit spreads. You've been hearing a lot about private credit, delinquencies in student loans, but credit spreads are specifically important, specifically the high yield versus the investment grade. If junk bonds start underperforming investment grade, the credit market smells fear before the stock market does. Credit guys are smarter than equity guys. It's just how it is. I don't know why. These guys just seem to be smarter, right? Maybe it's because they have to interpret a bunch of things more than just like line go up and liquidity, right? Who knows? Third, you should be looking at the yen carry trade. We've talked about this before. If the yen spikes, leverage unwinds absolutely globally. And right now, there seems to be no one wanting to see a strengthening yen. And what does that mean? Well, the probability and the propensity is for the absolute opposite to happen in these markets. Don't be the dog sitting in the burning Japanese sake house saying, this is fine, watch the spreads. That's what you need to do. Watch the spreads, right? If the dog starts talking to you, maybe you need to get your head checked in another way as well. If you are long stocks, you need to be hedging. Buying puts when the VIX is at 13 is like buying fire insurance when it's raining. It's cheap. Do it. Do it now. Don't worry about the outlay that it's going to cost. Hey, if you don't need the insurance, I don't mind if my house doesn't burn down, right? If you are a trader, stop trying to pick those tops. Wait for the snap, wait for the gamma flip, then ride the momentum all the way down. The elevator down is much faster than the stairs up because the market is designed to transfer money from the impatient to the patient, right? And from the blind to the observant. Because remember, in the land of the blind, the one-eyed man is king. I don't know how that fits in, but it does, right? Right now, the market feels safe. It feels cozy. It feels like the Fed has your back. It feels like Hessen's going to come in and start cutting. It feels like Jerome Powell has issued 40 billion of buying orders for treasuries. Everything seems to be going up. All the AI stories intact. But remember the turkey. Remember how the turkey felt on day 1, day 2, day 500, day 99, just before Thanksgiving. The volatility trigger is fully loaded. The spring is compressed and dangerous. The dealers are long gamma, lulling you into sleep. But the moment that level breaks, the snap will be prodigious, violent, and it will be unforgiving. Don't be a hero, be a survivor. If you want the specific gamma flip levels I'm watching this week, I will post them in my group chat only. No, I'm joking. I'll look to make a video about it, okay? If you guys like, share, and subscribe, and you give me a comment saying I want the flip levels of gamma, I'll do it, right? In closing, comment below, I am a turkey, or I am the butcher. Let's see who really survives in this market. My name is Justin Bunton. That's the House of Trade. Thanks for joining me on this volatility journey. And hopefully see you next time. Ciao for now.